Hey, greetings. Happy Tuesday, end of year, Jonathan. How are you?
I'm good. How are you doing?
Welcome, everyone, and thank you so much for joining. Let me do my video here. Closed captioning is on and all that good jazz, just not the video. So, welcome Tuesday guest captain interview, Jonathan Gibbons. We've got lots on the docket to talk about. Jonathan of VigTech.io. We're going to get to see a little bit more of that tool and specifically flows. Market structure is the name of the game in this regard. And then I've got some intermarket analysis I want to throw out you specifically on the dollar and Bitcoin. And let's get to it. How are you? It's end of year. I'm wishing I would have taken the whole week off.
Yeah, right. The typical action is not the action that you get, right? Like today was interesting, right? And it seems like um every day's a new day right now. It's not Groundhog Day. Every day's
Well, you've got some changes going afoot. So I actually retweeted that. And specifically, let me just show you that to be discussed. You have often expressed this complacency in the form of the single stock gamma option flow, which has been unrelenting, obviously, and phenomenal for bulls, especially speculative bulls. So I want you to share with me what I saw via Twitter and resent, because we've got, I guess, some changes afoot, or at least a tone. It looks like they're intonating some put buying and some risk off behavior that you can actually see in the flows. I can definitely see in my indicators, but still waiting for big turns and, of course, some event to trigger that, because that's typically what happens. There's some more time, if you will, of distribution under the surface, and I'd love to know what you're looking at right here.
Sure, sure. If you let me show my screen, I'll kind of walk everybody through that.
Go right ahead. Did I give you power?
You have to stop sharing, I think.
Oh, that.
Yep. All right. Let's see. All right. So what I'm referring to on a regular basis in my commentary, whether it be snarky or otherwise,
It's
is
fun.
this single stock, uh, basically the gamma functionality that market makers sell a call to somebody who's buying the call, then they have to buy the underlying security. So it's a rising tide lifts all ships. We've talked about that 10, 20 times in the past few weeks. And the 0.60 level on single stock, individual stocks greater than $20,000 in premium has been a marker that we've been tracking for, I think yesterday was 26 of 27 straight trading days, sans the one day that we had the brokerage account functions kind of fail that morning with Robinhood and a few others. IB broke that day. That was the only day that it wasn't under 0.60 in the last basically month and a half. And excuse me, since the election. And today, I've been mentioning it had been increasing the last week, like probably since we talked last week, since last Monday, it's been increasing. And today it closed at 0.74. So it broke the streak. So that's like twofold, right? Like the streak doesn't mean that it won't be back under 60 tomorrow, but what it really means is that it's rising, and so the complacency is starting to be overwhelmed by put buying, and especially if you jump up into $100,000 premium and up on individual stocks, because that's you got to have some weight to throw around for puts calls over $100,000, and that really shows a 1.12. So that's flipped to a totally bearish side. And if you look at the weeklies, right, even weeklies are 2.60. So there's a couple different interpretations on this. From just a sheerly kind of a gear shifting standpoint, you're starting to begin to see sentiment kind of burn out to an extent. Then there's the flip side of that argument that, oh, this is just some rebalancing these last few days of the year. This will re-kick the tires come Monday next week, right? And so I'm of mind that so a lot of other things are taking place that coincide with this shift right here. We've been tracking this shift for a while, but options are dramatically driving the entire market right now because there's more options derivatives being traded than our underlying securities for those options derivatives being traded. So the options are dragging the market. So whatever this does, the market's going to typically kind of go along with. Now, one of the things that I talked about in another tweet was volatility. And, you know, you saw this kind of really drop off. This is IV. So Vanna, VEX, whatever you want to call it, the implied volatility as it relates, you know, you got Gamma, you got Vanna, you've got time for a charm. But you've got implied vols up again today, right? They were down bad yesterday, but they're up today, right? So at least a little bit, which is, you know, you see that kind of play into a different story. I talked last night on the little cast that I recorded was that as long as IV stays down, it's easy for that drift to occur or for IV to be dropping, that slow Gorpy drift to occur. But that's also starting to shift gears too. So the big question now, I think, is this really kind of fizzling out, or is this these options flows, you know, kind of driving a larger story that people are beginning to change their positioning? So like ETFs are 2.03. So the index ETFs are pretty bearish, you know, and that's been a consistent basis over 1.0 for the last 5, 6, 7 days. So since we talked last week, after Monday last week, the thin tenor has taken place since last Monday. Now, it has been continually rising in price. Like, you know, Tuesday it got bought immediately and it rose all the way the last week. Even the IWM today was down pretty significantly. It's still above where it was last Monday, right? So, you know, the price has levitated. The securities flows have been running off. I can give a couple examples of that. And, you know, but don't want to go down too far down the rabbit hole. And then you've seen this tenor change in the options flows. So I think that it's a little bit more, it seems, than just maybe end of year repositioning. This seems pretty significant that consistently I've seen the flows from the underlying securities in the last week of November, first week of December, and have run off since then. The total momentum stocks have run off since then. So I call them the line stocks because they were, you know, partying a little too hard in South Beach. But like these stocks like Peloton, like DraftKings, etc., you know, they had been running pretty hot that everybody had talked about for a while. Penn Gaming, they've all really fallen off in the last few days, right? So these single Momo stocks have already been rotated out, and the flows on all these have started to peak out. And these flows hadn't peaked out yet. And I was kind of looking for them to peak out. So now we're seeing the options market shift that we were kind of looking for to see when is this going to potentially terminate. We're seeing the options. So the options flows, we're seeing the securities already underneath. Like if you looked at like Zoom, for example, this peaked back as a perfect example. What I mean, flows, that peaked back in the end of September. Price didn't peak until the middle end of October, but once those flows peak, then price genuinely follows. And so now we're starting to see the rest of this stuff kind of catch up to that. And it's just incidental that it's now beginning of January, you know, we got some stuff happening next week that could shake things up a little bit. So I think that that's a consistent theme that I'm seeing across the board, that these flows have peaked all right back in here, right? All the securities flows peaked back here. And then you saw the back in the beginning of December into November, price has not changed, and the options market has been steady single stock buying, and that seems to have crescendoed. The only caveat I'd have is the FANGs. It seems maybe a rotation into this week and into the first part of next week, because they were kind of, you know, playing, you know, coy to an extent. And maybe the people will rotate to that. But I'm seeing that the market is definitely starting to take the distribution is starting to take some weight onto the market. Now, I don't want to read too much into it until next week personally, because you do have some mechanics of year-end outflows and year-end inflows. And I don't know how much of that, like today was IWM, was how many people were taking profits.
Yes, it's tax selling day. It is year-end shenanigans. There are also a lot of observations of exceedingly high valuations and risk going into January 5th Georgia runoffs, not to mention, the 20th of January, the inauguration, where Trump may have his own private ceremony where he gets sworn in. Swear to God. It's don't laugh. I tweeted that yesterday morning.
I know.
Like they're like, you're crazy. And I'm like, no, I'm not. Or at least not to my family and friends.
Oh my God,
but
right.
There's also this screen. Let me just share with you real quick, kind of to go along with your Gorpy action. Margin debt. This is a pretty helpful client actually sent this to me, but something to watch out for. Margin debt, you're talking about this gamma, flow that's been exceedingly robust. Well, margin debt goes along with it, doesn't it? And it soared 50% in the past 8 months. And in the past 30 years, this euphoria has only happened twice, March 2000 and June 2007. Yeah. So we're right in historical levels, right? Yeah. And you and I last week, when we were talking about, okay, what do I see intermarket wise that has me also very suspect in regards to this, extremely overbought, euphoric kind of momentum. And I pointed to this chart from my Slack channel for clients, which was, again, from this 2007 to January 2018, where we had that big quick drop, to the February, March 2020, where we had a ginormous 35% crash. We're right up there again. So, and you asked, I think, for a closer look at it right here. Yep. So the most important thing, though, is how this, is extremely overbought. And we can go through valuation charts. We're going to see the same thing. It's very euphoric. So I love this quote, which I saw on Twitter. Someone you also really, really like and follow. This sums up, I think, the beginning of our talk and probably our last screen. Not participating in a speculative mania is arguably as crazy as not seeing it for what it is and having no hedge. Chris Cole.
Yeah.
So
absolutely.
Chaotic neutral is an ideal sweet spot. So, tight leash, know what you own. Don't do it for the fundamentals. I don't know what else to say, but there has definitely been this chaotic neutral of euphoric buying with lots of complacency, and the fact that you just started to see it come in your, I don't know what to call that. The indicator work is kind of indicating that they're front running potentially this January Georgia election, or even if that's nothing, more likely the January 20th dual inauguration. That's what I'm going for.
Well, I think that there's you brought up Tesla to discuss today, and I think that Tesla, Bitcoin, the Georgia runoff, they kind of are going to be there's some synergies to some of the underlying conversation there that are interesting. They're not really exact same things at all, but there's something about all three that I found looking at them that are potentially impactful. So whenever we want to kind of jump into that, I can.
So Tesla, let's talk about that one, because I have a time frame on Tesla that's more the March time frame, and I'll show you a chart that basically sums that up. What's your sentiment and your flow data showing on Tesla?
There's nothing like everything on my side is steady too. So there's nothing that says that there's a significant problem with Tesla at the moment. The thing that I found, and I think I would encourage everyone to read. Let me I'll share my screen real quick. I'll show you the actual sentiment first. So we'll look at Tesla itself. I thought I had it in here. Let's pull it up. So like the flows are still positive on Tesla, and it's in an uptrend, right? And momentum is over 50. So this, as long as the flows remain over zero, it's going to remain in a bullish posture and can continue to run until that changes. So I don't have a particular time frame in mind from a market structure standpoint on Tesla, personally, because I don't. It's just hard to say with that when that would change. Now, my take on it is I found this, um, uh, when I was looking at some different stuff, myself on different research. I hadn't looked at Ben's stuff in a while, but I'd encourage everybody to read this from Rusty Gwen at Epsilon Theory on the ZERP paradox, because when I was going to talk about Tesla, that's exactly what I was going to talk about, is that Tesla is going to run as long as earnings don't matter, right? And earnings don't matter as long as you're in a zero interest rate world, right? A zero interest rate policy world. And net, when would that change? And the only time it would change per se, and that's the same kind of thing that would change the Peloton, the pin gaming, everything that's not really got any underlying ability to create earnings or free cash flow or anything else at the moment. These are all just stock appreciation gambits, right? Speculative in a sense. That Tesla is a narrative stock and it's a platform narrative stock. And so as long as, Tesla doesn't make any money, it's all about what Tesla might do one day and the bid of the bid of the bid of the person behind the person behind the person. So what would create a change in the zero interest rate policy paradox is, inflation, right? And inflation could come from the blue wave and then a change of total paradigm to where it's not about stocks anymore, it's about redistribution. And so if you don't have the zero interest rate environment, then Tesla's, it's like literally you'd be lit on fire overnight because they wouldn't have anything of real balance sheet, anything of real income statement, and then that speaks to the value rotation in general that could take place next year. So, is there something stirring here as it relates to ZERP and NIRP that are maybe a proxy of the central banks, and then the fiscal and monetary policy head in the same direction that maybe overheats things? I think that directly relates to Tesla, in my opinion, and trying to do a price target or a call on when that takes shape. I'm not 100% sure personally, other than looking at the actual market structure. I just know that this level right here at 635, right, has been fought for and held for a while. But whenever that does go, fair value on Tesla is in the $400 level. Based on everything.
The 420 funding secured, right?
Yeah, there it is right there. 421 is actually the VPOC is 420, which is totally hysterical.
It is. And it's contrived. So yeah. I have a slightly different view on Tesla. Let me just show.
Go for it.
Okay. So mine is a few things. We'll talk about the NIRP and ZERP and all that as it affects the market. But Tesla to me is very much just, brilliantly manipulated play in that it has risen 1,200% this year. That's astronomical. And that just, it I think, points directly to the, what is it, 200% year-over-year change in retail trading accounts across the board. And I can show you a chart on that, which is just astronomical, higher than 2000, which is just, a beautiful thing. All retail comes in at the end, right? Yep. But the other thing is this chart, which I picked up from Spot Gamma. They're awesome. You know these guys. Is basically, we talked about the stock split really well, that timing of that short, which was really interesting, into the next round of a very large option activity. Right now there is a $220 million bet sitting in the September 720 calls, and they've just kept rolling from 600 to 700, from 700 to 720. So that whole, I think, exercise in not only chasing but also in the run up to when Elon's convertibles mature. And this is, to me, much more likely when this the money call options expire. And now it sets free kind of the bears, if you will, to come in and feed. But until then, there's no incentive for this to really come down. Not until that happens. He's got way too much ownership of the stock, way too many friends, way too much interest in, he loans out to cover to buy stock based on the equities increase, appreciation. So I mean, it's just a closed loop to me until this these big whales come off the board, and they're obviously out in time. It doesn't mean they're going to recover in September. It just means that they're obviously making sure that they have got that theta decay in case there is some issue with January inauguration or stimulus failure, or who knows what black swan event, right, could crop up. They've got some time on their very large bets, and it's not just one strike, it's a number of them. So I love how the value, if you will, is at more 420 funding secured level, but I don't think we're going to start to round this Eiffel Tower advance until basically the large amount of in the money call options expire and they start to take those off. That's my feeling. It's going to be February into March.
Very realistic, right? I mean, this is the number one, because it's not as it's the number one poster child, right, for this era, right?
It is. Poster child is the way to put it. And we'll talk about, the EV space and SPACs, but I wanted to comment on your NIRP comment. And this to me was very interesting because you and I have talked about the growth to value rotation trade and how it's really, until this week, of course, where they just started to come into big tech. Better to be safe than sorry and get out of some of the high momentum plays. So they did the profit taking, right, which makes a lot of sense into year end. But this NIRP, I love this quote, this tweet where, I don't know if you follow him, but he is the rates guy as it relates to Bloomberg, and very much under the radar. They've begun prepping member firms for the potential of negative interest rate policy in the US.
I don't see how they can do anything else. I think they'll try, right, to not do it, but I don't think they have any choice. But I'm not sure it works the way that they think.
Well, this is true, and I'm not, I don't have anything to do with this treasury market, physically trading it. I'm just watching, obviously, like you, how rates are impactful for this extremely bullish trade that we have on with the market, where corporations, good, bad, and ugly, have been able to go to the market and get tons and tons of debt and raise tons and tons of cash. And this is even before, or I should say, while there was a moratorium, if you will, on buybacks in large part. Some of them are still doing it, of course. But my point is, it used to be the trend. Then it went very quiet during COVID and the regime change, politically speaking, and now it's going to come back into favor because they got tons of money. But this also we talked about, and I wanted to grab that, which is the delta hedging of options will actually become more volatile to hedge the options market the lower interest rates go. And you and I talked about this a little bit because this was a Grant Williams podcast with Chris Cole, where basically NIRP can cause options to have higher delta exposure to the underlying than one. And that is not well known or anticipated. That could definitely pull the rug on the Teslas of the world. But I still go back to that one chart where I think this vested interest is going to be defended come hell or high water until these options expire in the money.
Yeah, I think that probably is their intention. I don't, we'll see if they can accomplish it.
Yes, true. Good point.
The Murphy's Law, it's like you can try and manipulate as much as you want, as long as you want, but then there's the thing that you didn't plan for that always comes into play, right? So all things being equal, probably that's the way that shakes out, but we'll see.
Yeah, and that was definitely why I thought it was very helpful to see that trend, if you will, of margin debt soaring 50% in the past 8 months, which is really third time in 30 years. That's a big deal.
Well, we were talking, I think we talked on the phone the day after last week on Wednesday, and we were talking about the habits of option buying. So once you buy calls and, you know, let's say you do it for 26 out of 27 straight trading days, your habit is, I'm just going to double down, right? Because it works. It just keeps working, keeps working, keeps working. So you would think that more than likely the margin debt increase, right, is directly correlated to the levering up, right, which is directly correlated to the habits that are created, which mean that on the flip side of that, they'll buy the first strike or pass down hard, heavy, double it down. That's what the psychology would do to that type of mentality, an unbalanced risk profile that's heavily all weighted towards the buy side. And that's all I know how to do. I've just done that for 6 months. It works every time. Why would I do anything different? So that can kind of level off or create that first kind of buy the first dip that maybe makes a one more higher, maybe does not. That's how I kind of see this shaking out a little bit, is that you got to, this is now a psychological situation with the market. The debt's at the 2000 to 2007 setup is there. It's sitting here now. So do you get a first pass washout, which everybody buys hard, and then you get the second one? That would kind of line up with your Tesla thoughts, March, right? It's a first pass, and then it doesn't take on the second attempt to stick it, right? And
no, we still need to see the turn.
Yeah.
And right now, we have end of year shenanigans or profit taking, but that's not necessarily the turn. However, the valuations are not just high in, as precedents, but the exceedingly high price into weekly and monthly Bollinger Bands are typically not where you want to buy, for example, semiconductors. You want to buy when they're on the bottom, just technically speaking. And something else which I thought was really fun, Chris Kimball of Kimball Charting Solutions, let me just do this right, shared this with me. He's a great Twitter buddy. And I love this. Winter and spring, so help me. He's got the pattern going on here. We're literally dumb money, right? And smart money, which is that index of sentiment where, retail comes in, but institutions are kind of like, wait a minute, this is getting a little frothy here. He also compared it with when they actually do their trend reversal, and it's very much winter and first day of winter, first day of spring. And I just loved this. I was like, that's actually pretty good timing. And then sure enough, on the 21st, we had a little rug pull there on a Monday, which was a rarity, because for the most part, we have had every Monday has been a gap up. Like, I think, I don't know, 35 out of 38 Mondays have been like a gap up.
Oh yeah.
I mean, it's been
since March. Yes, it's in the overnight action is the whole action, right? So if you bought open and sold at the close, you'd be like flat or negative on the year, I think.
So we've got Tesla, where that's why I'm thinking more of the we start to sell off, or I should say, January 20th, buy the rumor, sell the news. In other words, Biden inauguration. We might have some festivities there down in Mar-a-Lago with Trump having his own little ceremony, and divided nation and sedition talk and all kinds of nastiness. But the point is, this is definitely not over, and it seems a little bit too complacent. But year end, for the most part, flows have been bullish. Tesla hasn't given up the gains, the ghost, and big tech did see that revival. I had actually written to clients yesterday that for the most part, where is this? Oops. I'm still on. Oh, that's why. I'm on screen share. No, I'm not. Okay. For the most part, this, Santa rally is also right up until the 5th, which is the same as the Georgia runoff election. Isn't that curious timing?
It kind of all lines up with kind of large flow distribution opportunities. Like, you see these options changing, and people are starting to. I said this last week, and I kind of been saying, well, I say it for 2 weeks, and then just been saying it on Twitter too. Is like, if I were looking to reposition myself, this is the best time to do it, because there's not a lot of people paying much attention. And if I wanted to shift from maybe a net long to a net short, or go from net short the dollar to net long the dollar, or net long VIX after being net short VIX. This would be the best time to do it. And you know, because as everybody's distributing so much, the inflows are all confusing, the outflows are very confusing. Nobody's gonna be able to put a finger on it, and it'll be too late after everybody reads it next week in the published documentation for the commercial specs and so forth, where it'll already have taken place, because it's always a week late. So I think that there is distribution and repositioning taking place right now. You're seeing it on your indicators.
Oh yeah.
You know, and I think that you know, it lines up with what's the best. It's always incentive alignment, and that incentive alignment can shift. Like in 2018, the incentive alignment was to buy that dip because it was washed out. So 2019 was going to be beautiful, so they could tax harvest and then flip right there at Christmas Eve day. This is now the opposite, which is I'm going to sell maybe and reposition here, tax, you know, the opposite, right? I'm going to flip that whole script, but it's incentive. It's the best incentive this year. And then going into next year, I think starting 1/1, you've got a totally different gambit, because all the volatility got kicked into next year. So nothing got solved this year, and really none of the positions, none of the underlying economy and none of the actual market positions were solved this year. Everything got punted. So now what, right? And we start dealing with that immediately 1/1, and you've got you know, January's littered with mines. You know, you've got the Trump thing, like you said, and you got the Georgia runoff on the 5th. And if you get a whole blue wave, right, that does affect the Fed, and that does affect the monetary and fiscal policy.
Well, we'll see how that you know, Yellen appointment is actually going to help or hurt. But for right now, the outliers that have been so strong. Oh, by the way, I'm putting ARK in here because we talked about it last Tuesday, and it's down 10%, you know, since. So these are some outliers that are starting to correct into year end. We'll see if that continues. It's a bearish candle on the weekly. It's got lots of room to fall. But what I was wanting to point out was this valuation. You know, we've talked about where do we go from here. I love this. It's hard to read the detail down here, but the gist of this is here the change in the valuation metrics for these, you know, beloved, I'm going to call them the love children, right, of the super momentum stocks in SaaS, you know, the SaaS plays. It has been just impressive change in valuation. But look at the change in revenue growth. I mean, it's just the exact mirror. And at some point, this will matter. But we keep talking about this as just that kind of bipolar or bifurcated look of price action is pulling forward the multiples in the future. But the reality is, under the surface, this is definitely not reality. So it is a Disneyland type of theme park. And you know, you can ride lots and lots of rides. You know, it's not dangerous to your health unless you really, really just stay way past, you know, your threshold, if you will, of pain. I just think that this is a fun way of looking at the reality of the situation. And then the other was a chart that I found that I wanted to ask, because this to me was so interesting, this dollar that we've talked about as well, which has helped these tech plays tremendously. And I mean tremendously. By the way, I have to show the corporate profits too.
Share that screen so I can see it.
Can you see it?
Can't see it, no.
Oh, I've been talking without it shared. I'm so, what the heck? Hold on. What did I do? Did I not share the other one that I was just talking about?
No.
No? Okay. Well, I'm going to fix that. So first, okay. So I was talking about this chart. Do you see it?
Yep.
Okay. Apologize.
Yep.
This is the curiosity in the valuation extremes, where I have the saying outliers revert with velocity. There's got to be a trigger, obviously. Interest rates would be one, a higher dollar as far as macro. But this, it shows the change in valuation. You can't see the plays right here, but this is, you know, the Twilios and the Elastic and the Lemonade and the Tesla and the, you know, all the love children, Smar and Microsoft, et cetera, et cetera. And yet the change in revenue growth for a number of these. This is basically that mirror image I was talking about, where multiples have just surged, where growth, however, has not, right? So that was the one chart, but the other is really more important to a macro standpoint. By the way, this is I was referring to the increase, the explosion of retail trading growth accounts, right? Like 200% year over year. It's insane. But this is the chart that most interests me. I'll go back to this one. The dollar. This is fascinating to me. And I want to check if this is for real, like correct. But it was sent to me on Twitter and I looked at it and I'm like, this is so interesting to me, where this is the dollar, right? The Dixie is here since this 2014 surge. It's gone sideways, but the basket of reserves, the share of the dollar in foreign currency reserves has fallen. To me, this is, I just have not, is this a catch down? Is this a catch up? Are we going to have a liquidity shortage here where the dollar spikes higher into price, or is price going to fall and catch down to this supply? This to me was sent to me by this individual, and I thought it was very, needs a little bit of fact checking, but I like it. I like to see if this is in fact accurate and how this is going to resolve itself going forward into 2021. But that's a big deal of why tech has obviously been able to rise so much. Dollar has just been muted, incredibly so.
Yeah, absolutely.
So that was my dollar take. What's your dollar take?
I haven't really. I was actually joking with somebody the other day because I said, "Am I like a broken record, like one of those bad broken records that you're like, hey, take that one off now, right? Like nobody wants to hear that anymore." But it's only been like a few months, and the guys have been calling for $10,000 gold for like 15 years. So like I
love this. You've got to be convicted, Jonathan.
Yeah, you can't give me a hard time about this. I think that the dollar is going to catch that's going to catch back up. You're going to have liquidity issues, right? Like, so, this is speculative mania, not unlike things historically.
You can see my chart, right? Corporate profits after tax. And I said,
this
is not a timing tool, but this is a come to Jesus talk in the making.
And so this is a catch down situation. At some point, all the setup is there for it, and just on a sheer market mechanics situation, right? You're gonna have the dollar be liquidity. So like, it's not. I go back to my dollar conversation is just sheerly structural and mechanical, like plumbing. It's not like I hate Bitcoin or gold or anything like that. It has nothing to do with that. It's
nothing to hate.
When you actually have to become liquid, right? You go to what? You go to dollars.
Yep.
And when you go to dollars, right, other things pay a price for that. And so tier one collateral, for example, like even if you have gold's margin called. And so, if your brokerage just think about what you showed me with margin, right? When margin's way up, it's fine. I saw something yesterday, it was a great example of this. It was somebody saying that somebody on their chat or Discord or feed or whatever had gone from like $500,000 account to $2 million account, and they snapshotted it. And in that snapshot was a margin call, and they were being margin called on their account, and they had to liquidate their positions to get back to their margin level. And that doesn't mean that the account was over, was in bad shape or anything like that. That obviously had a great appreciation on the year. But what happens is once selling starts, right, then everything has to be liquidated, right? And everything is everything, right? And dollars have to be raised, because until the banking system changes, the dollars are what tier one collateral is pinnacle, right? Dollars and treasuries at the bank, at the Basel structure for the banks, and it will be for all the brokerage houses. So all of the major institutions, everybody has to get to dollars. Until dollars are no longer the reserve currency, that would be a change where I would say, okay, even on a catch down situation like that, it may catch down on just some natural like price depreciation instead of appreciation value. But at the end of the day, when you have that liquidity crisis that's inevitable at this point, it's just a matter of inevitability versus imminence. Is it imminent or is it inevitable? I don't know. but it is coming. Once that takes place, you have a mechanical function where the dollar is just gonna rise. Go back and look at March. The dollar wasn't supposed to spike like that in a natural environment. That was a liquidity problem, right? And so you're going to see that again. And this gold is always torched, like just thrown out, like because it has to be sold as that collateral for the margin calls and for the rehypothecation. And now we have the penultimate margin of all time approaching, right? And we have rehypothecation across the board. It's just simply, I call it like an XYZ problem. So X plus Y equals Z, and until that changes where the dollar isn't the currency that everything has to go back to in a liquidity situation, then it will still, it's still gonna play its role. After that fact, different story, right? Maybe there's something different after that fact, but we're too close to some sort of liquidity problem again, because of all the different market structure things that are going on. And I think gold just gets hit, and Bitcoin is a front running liquidity proxy.
Yes, and as the dollar has also faded, Bitcoin has run into the hot sun. But take a look at, I know, and again, I just grabbed gold bullion sales since October 1st are up 700% higher than last year. Yet the paper market, which we trade, right, the GLD, has fallen, and it can't get up. I mean, it's had little bounces, but it goes right back down. And I showed that last week, and I keep, eyes on the prize, if you will, of my bullish percent index for miners, which has been a fabulous tool to time gold, precious metals in general. And there are two comments on this. I mean, yours are definitely macro, big picture, very important. Miners still sell off with stocks, right? As a hedge, it appears there's clearly some buying of physical, but the paper is to be caught up. But this in particular, this gold miner percent index, which I've shown before, first and foremost, when I hit 100, that was my call short on the gold, the precious metal trade. That was back in early August. It has had bounces. We were actually on the line one day when it just exploded higher, and we were both like, yeah, we think that's a fake, extremely strong bounce, but that's a fake out. It's going to have a fast failure. And sure enough, it collapsed down. We've now had another bounce that everyone is talking bullish about gold because there are diehards and they understand it is, an alternative to our usual, we're not rotating into cash. Cash is losing value. It's losing power. If we get those stimulus checks, spend them quickly because it's going to be worth less. So the whole point is I still see this in a chop to drop before it's really viable. And I keep preaching that since August. And so far, this has, been right. And it's not done as far as I'm concerned. I still think we have one more push lower before we get that, hot fire flame type of move again.
I like the mining sector. That was the best trade on the books for me in 2019 by far. And I've historically always loved the mining sector. So I don't want anybody to get confused by my posture on it at the moment. But my posture on it right now is that it's the same as yours. Like we keep hitting this ceiling right here, XJ and GDX, and you got the weight of the volume profile of the market sitting on top of this, and this is just kind of continually fading down. Every time it pops up, GDX looks a little bit worse. Even this week, like yesterday, day before today, it popped up, gets sold, distributed. I quoted that out there, and then silver got right to the apex of filling that gap and failed and turned over.
Yeah.
This is very hard for me to see, and we've touched on this almost every week. This $17 to $20 level in silver just has not been revisited at all to determine, fair value and the auction stuff down there. I think as soon as this gets dealt with, then you could see some serious volume come into this space and really make a turn. Because I'm very bullish this. Both from industrial use for silver and then the monetary use for silver. The mining stocks for silver miners are always way outperforming. And I think the use case for Bitcoin and the crypto stuff is still TBD. We'll talk about that in a second. I know you want to talk about Bitcoin, but like I think that's still out in a few years. So in the meantime, like hard basket stuff, I think the digital yuan is coming, and that's going to be quote unquote backed. What's going to be backed by? It's not going to be backed by Bitcoin. That's going to be backed by the 20,000 tons of gold they have, right? So because you have to have confidence in the currency that's distributed. So I think that silver and gold are great. I just think that we go lower. I think that 20 handle on the BPGDM is probably a fair estimate that gets tagged before, right? It turns. I'd be curious on that, where that is for you next week when we look at it again, and the week
Which
after.
one?
On the gold miners bullish percentage. So BP.
Oh, yeah. So it has not tagged my level yet. It's got
20
lower.
or below. Yeah, that's historically a good spot for that, like you've shown on your chart there. So I'm seeing the same thing. This is really loose price action. I'm really bullish like PMs, and I'm bullish inflation trade, but not before we see some sort of deflation trade first. And it could be a pretty sharp deflation trade. I would not be concerned about silver above 17. I'd be concerned about silver below 17. I'd be concerned about gold below 45, but anything above 45, I'd be pretty bullish on long term, especially when you look at these things zoomed out on the weekly perspective. This isn't like 145 is nothing, right? When you zoom out, like people could be screaming, death to the gold again, and 140 would be literally just kind of catching the bull bear pivot on a weekly basis. So I think that just from a structure perspective, these are really heading down to these levels before they go. I don't know. Yeah, there's never anything guaranteed, but I see the lower before higher too.
Well, there's another chart I want to share, which is kind of this play, if you will, the intermarket that I shared a few weeks ago. And I know it's really messy, but stick with me for a minute. So this is copper and gold miner ratio. And then the underlying, if you will, in green is the 10-year yield. So the reason why I put lines on everything, it's just technical analysis. I look for divergences and outliers in intermarket analysis, but I look for entries and exits and good old fashioned trend lines and moving averages and Bollinger Bands and the rest. And this had been a fabulous, breakout with the copper GDX ratio, which is basically, you want to go to stocks that are tied to base metals, copper, steel, blah, blah, blah. That's the inflation, reflation trade that we've had, the cyclicals, if you will, that we've had strongly, the FCX, Freeport, et cetera. And then after the Pfizer vaccine, or right before the Pfizer vaccine came out, U.S. steel just shot up like hot fire flames. So some of this, of course, is that, the China trade, some of it just the dollar, it continues to fade. But a lot of it for me is this ratio just continued to grind higher while the 10-year kind of stuck around here on the lows, sideways, I should say, nothing really hot fire, no yield pop of dramatic means, nothing over, for example, 1% in the 10-year, right? So it stayed pretty calm, all things being equal. And TLT, has just been wedging, but it has not made dramatic moves. So they really haven't gone anywhere, which has been very conducive for the market melt up. But this ratio, that I just posted actually for clients again yesterday, correct? Yeah, yesterday. Gold miners are weak relative to base metals like copper, but now this ratio is tagging some resistance levels. I expect base metals to come down. And, even today, iron ore and the rest over in China is getting sold in their overnight market pretty strongly. So there is some volatility coming into the base metals. XME, for example, that ETF. I don't know what your ETF XME looks like on your chart, but that is one thing I wanted to share, which to me just says it's time for, relatively speaking, those commodities to calm down a little bit, and then next year miners can take off again. But a lot of that depends on yields. The other thing was this tweet. There it is. Jim Bianco, who I love, Bianco Research. It was a good thread on an analysis on rates, commodities, inflation, and GDP. And in particular, what I liked was his explanation of, nominal growth is rising, which is basically, I'm loosely translating here, real growth plus inflation, right? This is nominal growth. It's slowly accelerating. You can kind of see from this breakout here on this chart. But the question that you and I are asking every week, is it from real growth? Is it from inflation expectations, like that premium that's getting bid up on forward-looking vaccine has been deployed, nobody dies of it, everybody's back to work, everybody's back to normal. So is it that inflation expectation that's basically driving this or pulling it forward?
I'm B, 150%. Like there's too many breakdowns. Like if you have real growth, you don't need a second PPP loan, right? Like, the small business stuff that got issued yesterday with the Trump signing the other trillion or whatever it is. I can't keep up anymore with.
I know, and it got blocked today by McConnell, the 2,000.
Yeah, they'll
on again, off again.
When he gets whatever it is he's looking for, he'll pass it on down the road. So it's all inflation, right? It's all inflation expectations. It's all kind of the reopening expectations. But this is all big systems take more time to sort through big problems than a small system takes time to sort through a big problem. We have the United States, the world too. It's the entire world trying to get back to work or deal with all the different things that are happening. And I read a thing from a hospital CMO this past week that was talking about vaccines being distributed. Not negative. It wasn't negative. It's positive. They were talking about here in Florida distributing the vaccines to frontline workers and then to the above age folks that were at high risk, and then the people in the nursing homes, and they didn't have enough. They're not even close. Like they need 8 million doses, and they're getting 400,000. Like, and then the next month it's another 4. How long is that going to take? And I know they're ramping all this up and everything like that. That's a big, we full bet, right? We full bet that all this is going to take place instantaneously. Yeah, it's just going to it's going to run hot. And is that feasible? And then, so what you have running hot right now is certain aspects of the economy while others are just totally blown out, and totally gone. So I think that, deflation, right? Disinflation, then a real inflation based on all of it catching up, because, people are still hoarding cash, right? Like banks are still hoarding cash. They're not lending either. So I'm with you. I think it's gonna be a lot harder to get that cooking than that just blanket expectation, right? That we're gonna be at full capacity, full production of the economy next year. I don't think that's realistic at all. I think that maybe 50% to 70% would be realistic, but that 100% is crazy.
I know. I like the comment in chat. Inflation groupthink ... Meanwhile, they are briefing the member firms on NIRP.
Great comment.
Do what they, watch what they do, not what they say. At the same time, I hope I can, this is very small, I apologize, but I just grabbed this because I was thinking of, can you see this? EPS growth estimates have started to fall again this month for 2021. This is what's, we've pulled so much forward in expectation that everything is 150% better.
Yep.
I hate to use this because it makes me nervous when I say it, but it's priced to perfection, which is, very much that you just can't get better. There has to be some air out of the flow here to settle down, and then are we going to really be in that situation where we have, hold on, where the heck is it? Yeah, that's the 10-year. Yeah, basically everything looks the same, right? I mean, I'm just going to show this chart. This is Suburban Drone, not my work. He's another one on Twitter. I mean, look at these reversions back here to just a basic 200-day. You know what? They all look the same. Tesla, Nvidia, Apple. I mean, Bitcoin. They're just parabolic on, you know, a monthly or a weekly, just a weekly chart. So to me, that's what I have in expectation, if you will. Oh, I didn't share it with you. Duh. Do you see this? Sorry.
Yeah, I can see it.
All right. So to me, those are the types of opportunities that when they come to short, how much time will we have? Will we trust it? Because every dip has been bought. Will it, or will it turn into like a BABA?
I think the short is the trade, you know, shortly, right? Because you're talking about these massive moves. You just gotta like actually tactically trade short, and then you're gonna let them run. I think catching it may not be the problem. Trusting to let it run is gonna be tough. That's gonna be the tough. So you got to be very very structured in your thoughts. But these mean reversions on some of this stuff, it's a bid for the bid for the bid because it's a zero interest rate, you know, paradox situation. Everybody's all that earnings expectation and everything's just farce. It's just garbage. Everybody's just selling the next higher price to justify it. Soon as that changes, then there's like, what's the real price? So the whole like common knowledge flips, and then you've got the options sitting into it. So I don't think you'll have a problem hitting those mean reversion targets. Let's just put it that way. I'm not like bearish, like, oh, you know, there are so many hatred things said for bearish people right now. You're like, you can't, what do you call it? Like you're not American, and you're anti-progress and all this kind of stuff. It's easier to be, you miss out on all the money. I think that it's a matter of this is all just bid on the belief that there's going to be a higher price.
Well, or that the Fed will just continue to have our back. So this is another one, and this is in comment to someone in chat who basically, I don't know if you can see the chat comment. It's a good one. Hold on. But more stimulus is coming in 2021. Yes, it is, isn't it? 120 billion per month, bullish for stocks. How does that fit into your short bias? And not to argue, this central bank, you know, asset extravaganza has mirrored the FANG and the indices pretty tightly. If you were to look at this from a fractal, the more liquidity they infuse, the higher stocks go until something breaks. So we're talking about the break being NIRP is actually negative. I mean, it's just
yeah.
And so is a higher dollar, you know, if we were to get it. But then so is just a case of vertigo.
Well, I think the whole premise of that. There's another one here. I think here. Let me share this.
Yep, I'm stopping. Go ahead.
I'll answer this question with something to go read. This is so
in other words, they're not wrong to have chased this long, nor are we. But the point is, we're going back to that Chris Cole sentiment, right? The very first I opened up with a very smart comment. You know, chaotic neutral is an ideal sweet spot. Not participating in a speculative mania is arguably as crazy as not seeing it for what it is.
Yeah, this is a great. This was last week or the week before, and William is a big tech guy, and then also a follower of you know, what we do, and I didn't even see that this is, you know, that's his handle. This is super interesting read, okay, as it relates to the Fed put. It's a anecdotal kind of metaphorical take story / whatever you want to call it. I would highly suggest everybody take half
cool.
hour
Okay.
this, okay? Ben picked it up and posted it, this whole thing. And it's all about the expectations, the Fed put, the 10-year yield. So it's not really that really has an impact. It has an impact psychologically. And so if you are to get a change in the psychological impact via NIRP, right? Or, right, with the Fed becoming, you know, stocks aren't good. We want the polarization of inequality to be rectified. Fiscal's going to take over bad stocks, right? Like these things are something you don't know how that shakes out until January. I would say that bullish stimulus perception for the, the boosting it at $120 billion per month, that is all about the overnight gap ramping camp, right, type of triggering. And that is supported or it's not. Is that going to be not supported? Is that money going to be changed to where they direct the way that goes? The couple of people have said that, and I was like, I didn't really think much about it last 2 weeks, 3 weeks, but I am genuinely put that on the table that if the NIRP, ZIRP environment changes, right, and the perception of the Fed put changes, then it will change everything for equities. And that would dramatically change the vol structure and everything else. And isn't that like literally be careful what you ask for, where you want inflation and then you get inequality and then you have to rectify the inequality and therefore you can't get the, you've solved the problem you thought you were set out to solve, but it creates a totally different problem for you. These are the types of unintended things that when you print 20 or whatever globally, $20 trillion plus is that has to be sorted through, and we'll find out early. I think we'll find out more pieces to that puzzle to answer that question each month there in January. That's my 2 cents. Starting in January is like you'll get a little bit better perception of whether that's going to be the same thing that it has been, because we're entering a little bit new territory next year. That's my 2 cents on that.
And I would just comment and close that for me, it's more of a regime change, and I just put in chat, especially the last 4 years, it's arguably a case of profits over people.
100%.
And this may be a turn where it becomes people over profits.
By fiscal decree.
And the market is not prepared
not ready for that.
Keep pricing in stimulus, liquidity, but there might also be some intended consequences, right? Higher taxes, antitrust, whatever. They'll still see bullish, I know, but they're definitely on the Yellen front. Let's see what happens in this, inequality that she keeps talking about. How is that going to be rectified? What if this does turn into people over profits? Imagine.
Yeah, well, that's inflationary, right? Because the money's not going to the banks. Banks, will that's a different scenario in the way that the money multiplier works. That's money going to the people, and money going to the banks that go to the people, right? That are required to be given to minorities or women-owned enterprises or whatever. These are the types of things that they're talking about. These are different. That is inflationary, like really inflationary, that money multiplier. Like you've got it, but it's disinflationary for equities. So you've got it. This is going to get if this year was difficult, I think next year is just as difficult, maybe in a different way.
Yep. And I can't help but also wonder how it's going to impact this dollar flow. 70% of dollars are held abroad. Like, where does this come back into the picture of bidding that sucker up again? But for right now, they are positioned short. Rates are low but not negative. The markets are screaming higher for the most part, grinding at the end of the year, but into January 5th, likely front running a little bit before the 5th, but I would say into the 20th. Would not surprise me if we have a dual inauguration, believe it or not.
It's just wow. Is he gonna have his own network cover that? Is that what that is? It's like,
say again.
Is he have his own network lined up? TV
network? I don't know about that. It's just a suspicion I have that he's not going to go quietly into the night. They've done their job of open sedition. We'll see if it continues, but it's just a sentiment that there's some more surprises to come, and the market doesn't care. Just
I'm going to keep my game plan real simple going into 2021. I'm looking for a correction or more at the 3330 level and the SPX. That's the level for me that everything sits at. No matter if we go to 3800, 3900, 3850, 3750.
Did you say 33? What did you say again?
3330. So 3330. Right.
That is too funny. I'm just going to end. Yesterday,
right in the middle.
I put some end of where is this real quick? This was just for my clients yesterday because I'm really kind of coasting into year end, end of year, market thoughts. There's cyclicals and values still bid on lower dollar Fed support, blah, blah, blah.
Look at that.
Look at this. Look at this. Pair this with all-time low interest and high hedge fund gross net positioning. We have a scenario for a great correction to 3,300.
and it's either, and we'll find out market structure wise at 3250 to 3380 is why I said 3330 is set dead in between roughly. Is that are we experiencing a correction, or are we going to get all this options unwind that just nukes it again? And then we're kind of back to the drawing board where we break that 3250 level.
Yeah.
We've got some significant displacements that will take place quick. So yeah. I don't know, nobody knows. I just know that like the reality of the situation is we're really extended. There's been a lot of buying there. So you'll find out weak buying on soft volume up since November, and all that's got to be retested. And if it's like really inflationary and all the levers get pulled the right way, that level will hold, and then you'll see it turn. But if not, then that level will not hold. And there's plenty of nitroglycerin sitting around if it doesn't, to just get going. So well, that's pretty cool from two different perspectives.
I know, it's so funny how we keep coming up with the same, totally different approaches, but it works. All right, let me just put this for anyone to keep in mind that this will be uploaded. Let me share. Yes. All right, so thank you for participating today. There will be not only an upload under the guest captain interview page, but also on my YouTube channel. So I want to also suggest vigtech.io, where not only does he write a fabulous occasional daily, disarmingly funny, but also good market flow information. We kind of hit a lot of kind of like a sector review and market overview, but he digs in to actual levels, which I send to my clients. But subscribe to my trading channel, and you'll get notified every time that this is uploaded as well, which is Tuesday. And we're going to do it again next Tuesday, and then we have a week off. Yes, because we've got New Year's. No, we have New Year's. Yes. So next, I got to put you in there. You're on the yes, I got to get you on the 5th. So let me put that right now. And then I've got two things that I want to just mention. Not this Thursday, obviously, but the following Thursday, I continue my Women in Trading and Finance seminar with Sang Lucci. And then the following Thursday, I have not one, but two special guests on for that Thursday time slot, 4 o'clock at the close, to talk about the beloved love children, the love children, if you will, of SPACs, and very nitty gritty details of an investor who has been trading them since 2007, when they really just hit my radar in 2017. So I'm a youngin' when it comes to this stuff. And also someone who writes these and brings them to market. So an actual originator of these SPACs plus an investor in these SPACs. So there are two experts, and it was a client who said, I think this would be a good topic because there's so much involved in the units and the warrants and the stock, and this is not my wheelhouse. So I've got that happening in 2 weeks. So look here on this page, guest captain interviews. I'll update it for Jonathan next Tuesday. And I wish you a great holiday.
Happy New Year.
Happy New Year. We get a few days off again. Woot woot.
Yeah, that's right. Put 2020 in the rear view.
Oh my goodness, cannot wait. Okay, thank you for sharing all of this. Sorry what ran a little bit late. Hope it added value. And again, see you in the new year.
Take care, everybody.
Bye.